In January 2023, The Guardian, Zeit, and SourceMaterial published a joint investigation into Verra, the world's largest carbon credit certifier. They're finding more than 90% of Verra's rainforest offset credits, representing over $1 billion in offsets sold to corporations to meet net zero pledges, were not backed by real emissions reductions. The forests they claim to protect were not under threat. The companies that bought those credits paid for the right to keep emitting carbon in exchange for a certificate that meant nothing.
Carbon credits were conceived as a market mechanism to price carbon emissions. A company that emits beyond its permitted level pays another entity, a forest, a renewable project, to reduce emissions on its behalf. The accounting requires additionality. The offset must represent reductions that wouldn't have occurred without the credit. This is where the fraud lives. Proving that a forest would have been cut down without your credit, proving a counterfactual, is methodologically impossible to verify at scale.
The voluntary carbon market grew from under $300 million in 2018 to over $2 billion in 2022, fueled by corporate net zero pledges. Delta Airlines bought $137 million in carbon offsets between 2020 and 23, then declared itself the world's first carbon-neutral airline. The investigation found that a substantial portion of those offsets were from Verra projects with no demonstrated real emissions reductions. Delta's carbon neutrality claim was based on certificates that certify nothing.
The financial architecture creates structural incentives for fraud at every level. Project developers are paid for credits, so they overstate reductions. Certifiers like Verra are paid by project developers to certify their credits, so they approve projects. Brokers earn commissions. Corporations can meet ESG pledges and avoid regulatory scrutiny, so they don't look hard at quality. Everyone in the chain profits. No one in the chain has an incentive to verify that real reductions occurred.
The broader ESG investment framework, environmental, social, and governance, held approximately $35 trillion in assets under management globally by 2022. Studies by Columbia University, NYU Stern, and others found that high ESG-rated companies did not have meaningfully better environmental or social outcomes than those without. What ESG ratings measured reliably was a company's ability to produce compliant disclosures, essentially its ability to generate paperwork.
The institutions that built this market are not naive. McKinsey, which helped design voluntary carbon market frameworks for the Task Force on Scaling Voluntary Carbon Markets, also advises major fossil fuel companies. Goldman Sachs has an ESG investment platform while being the leading underwriter of fossil fuel bonds. The same institutions that created measurement frameworks for sustainable finance are selling products to both sides of the transaction. This is not incidental. It is the business model.
After the 2023 investigation, Verra revised its methodology. Several corporations quietly removed their carbon neutrality claims. The ESG framework is under regulatory scrutiny in the US and EU. Whether this produces real accountability or a more sophisticated version of the same paperwork is the question. The history of financial market self-regulation suggests the answer. Carbon credits are not a failed experiment. They are the system working as designed for the parties who designed it. Subscribe.